from the very beginning. In episode 1, we were able to identify the scientific origin of poverty and wealth, which was clearly explained. In episode 2, we identified that credit creation, which is the largest financial product available today, does not solve the problem of scarcity that beneath the circular flow of income, and as a result, it does not counter poverty, and which is why we still face problems to do with scarcity today. Unemployment, inadequate medicines in hospital, people not getting adequate insurance coverage, people going hungry, people being homeless. All of these problems within the economy go directly back to the problem of scarcity beneath the circular flow. So we identified that credit creation, although it does increase the supply of money, the vacuum between households and industries persists. So it does not offer a solution to that problem. Then in episode 3, we looked at what would happen if that vacuum were sorted out by a financial service that runs alongside credit creation that I called wealth creation or resource creation. What we saw is that if you're able to plug the vacuum of resources that is being lost below the circular flow of income, it has a dramatic impact on how the economy behaves and how businesses behave. It improves the conditions in which businesses operate. Instead of the economy working against businesses, it now works for them. Instead of it trying to shut them down by increasing their costs and pushing them below the break-even point, you find that it now lifts them and tries to push them forward and keep them afloat, keep them going, keep them prosperous. The difference between an economy that has wealth creation and one that doesn't is quite significant, as you saw in episode 3. In episode 3, the prices of goods and services are lower. Consumers are therefore able to purchase a lot more goods and services, so the economy is persistently in a booming state. Businesses face lower costs of production. The total revenue they receive is equivalent to profit. Therefore, they're able to employ more people, they're able to invest more in research and development, they're able to buy more raw materials, they're able to grow much more quickly than they did before wealth creation was available. Now, in episode 4, we're going to look at the circular flow of income and basically try to assess the statutory requirements or the statutory environment that provides the backup or support that creates the resources that end scarcity below the circular flow of income.
Here is a simple explanation of how wealth creation works. A loaf of bread sits on a supermarket shelf. The loaf of bread costs $8 to buy. This $1 is in the hands of households. It is part of existing money supply or existing GDP. When the loaf is purchased by households, this dollar is received by industries and spent on their production costs. 40 cents worth of this dollar goes to households and 60 cents goes to capital or raw materials. In this payment system, at any point in time, households hold 40 cents of the dollar and businesses hold 60 cents of the dollar. 40 cents is missing for raw materials as a deficit. While 60 cents is missing for households to be able to afford the bread. Since the payment system cannot put the loaf back on the shelf automatically, as money has no reproductive value due to subtraction taking place below the circular flow, the value of 60 cents is subtracted from households, while the value of 40 cents is subtracted from businesses, reducing the productive or reproductive value of money to zero. When a dollar is forced to perform two tasks like this, the efficiency of money supply drops by 100%. Creating a financial loss of $1 to businesses, creating scarcity or poverty as we know it today. This hidden loss goes unseen. And a drop in productivity or output equal to $1 or the loss of one loaf of bread. Once again, this hidden loss goes unseen, creating scarcity or poverty. When wealth creation is introduced as a financial service, the architecture of the payment system changes. Wealth creation is able to shift money in two directions at the same time of the same value. To households and to non-human capital, allowing capital and households to equally receive $1, simultaneously moving in two different directions, or split velocity. This new or additional dollar is a new channel of money supply provided by the Reserve Bank. The efficiency of money supply now increases by 100%. Split velocity is now applied. This means money moves in two directions simultaneously rather than one, preventing inflation. This process is referred to as split velocity in the Greater Poverty and Wealth of Nations. Split velocity creates a financial gain of $1 and an increase in productivity or output equal to $1 or an extra loaf of bread. This means that as the loaf of bread on the shelf is being bought, another is simultaneously being produced to replace it. Money supply now has reproductive value. This means that as the loaf of bread is being consumed by being purchased, simultaneously another is being produced to replace it. Back on the shelf, thereby doubling business productivity. Doubling output equally accelerates annual growth in GDP in an economy by accelerating the activity of businesses. And the funds to purchase the new loaf are already in the hands of households, ensuring that economic activity continues unhindered and at an accelerated pace at constant price, since the output of goods and the value of money remain at par or equal. Money supply now has the new payment architecture of wealth creation. Number one, this accelerates productivity. Two, it alters the behavior and characteristics of money supply. Increases in money supply in the new payment system would tend to cause a fall rather than an increase in price due to increases in the efficiency of money supply.
I did mention in episode 3 that the resources required for the circular flow of income are pre-existent in the economy. You don't have to get those resources from outside the economy. The income required to plug the hole in the circular flow of income is within the domestic economy. You don't need to reach out. You don't need to borrow. That said, that income is a money supply deficit. In other words, it's money that is missing from the circular flow of income that is supposed to plug this hole that is draining resources from businesses and making it impossible for them to grow at a pace that will meet the needs of the economy, of government, and people living in that environment. So as you can see, since it's a money supply deficit, it is really the responsibility of the central bank and the Ministry of Finance to plug this hole. Resource creation is a service. Just like credit creation, banks do not print money. They do not supply money. The printing and supply of money is the sole responsibility of the central bank. Banks receive this money from the central bank and redistribute it as credit creation. Now the same applies to resource creation or wealth creation. The central bank and the Ministry of Finance have to step in. The Ministry of Finance provides the regulatory environment, the rules and laws under which this service operates. The central bank will supervise and manage and provide the money required for this service to be provided in exactly the same way that credit creation is managed today in the economy, with one basic difference, and that is wealth creation. The manner in which this money is distributed as a service plugs the hole between households and industries, thereby freeing up scarcity and allowing wealth to be generated in the economy. And the financing that is required for this, or the money supply that is required for this, is equivalent to GDP. Now the interesting thing is, because it's a deficit, when this money is supplied through the wealth creation process, it does not create inflation. And if you look at the model, the interesting thing is that this is probably one of the few times in economics where when you increase the supply of money into the economy, rather than experiencing inflation, what you would tend to experience is deflation. This takes place as a result of the model or the design of the financial system behind wealth creation. That in itself is a first in economics, because the belief is that if you increase money supply, then automatically the result is that prices go up and inflation takes place. However, with wealth creation, because you change the behavior of businesses and the behavior of consumers, what will tend to happen is an increase in money supply will tend to create a drop in prices and a drop in inflation and greater stability in the economy. That's something that we can explain in greater detail as we go along.
The cheapest, most cost-effective method for stopping scarcity beneath the circular flow is for the Reserve Bank to supply the money to stop the deficit. The central bank provides the money supply like it does for credit creation. This money supply is equivalent to GDP. The central bank creates a new channel of money supply to facilitate wealth creation. This money supply is accelerated using split velocity at constant price, which in turn accelerates the activity of businesses in the economy. Wealth creation as a financial service ensures this supply occurs at constant price. This money supply is equal to GDP. Wealth creation as a new financial service virtually guarantees this increase takes place at constant price. Constant price means the increase in money supply takes place without inflation. A commission is charged for distribution of wealth creation as a service. This equation shows wealth creation introducing an additional $20 billion worth of financing in the Zambian economy, of course distributed in kwacha at constant price, pushing financing up to $40 billion in 1 year. The $40 billion in GDP consists of $20 billion of original GDP and $20 billion of new financing from a new channel of money supply. Correcting the circular flow generates this additional wealth or income for businesses per annum.
When I was introduced to economics in my first year at university, it was one of the most exciting things to be able to learn, because in your first year, basically, the subject defines terms for you. What is demand? What is money? What is demand and supply? And you learn the graphs, and it's very exciting to be able to be introduced to these terms. But growing up, I was very passionate about finding ways of addressing the poverty that we see around us. And I was more interested in finding ways of addressing poverty that don't have to do with handouts and aid and so on. My feeling, if you look at businesses and how they operate in the economy, my feeling was that if you just created a conducive economic environment for businesses, you could actually provide a sufficient number of jobs, you could provide sufficient resources that would be enough to take care of everyone existing in an economy, enough to feed, clothe, house, provide the sort of amenities that lead to the happiness the economy should enjoy. So my approach to finding a solution that would enable businesses to do this was to look at the environment in which they operate in. And that essentially meant scrutinizing what we've been given to understand or given to learn in economics and finding whether this actually works for businesses.
How does wealth creation allow financing equivalent to GDP in 1 year to be introduced to the economy without causing inflation? This cannot be done using a normal or the existing payment system found in the world today. Wealth creation introduces a new and unique payment system for industries. Here is how it works. When households make a purchase from the market, from malls, from stores, these payments are received by industries. These industries will have a payment system based on wealth creation. The architecture of the wealth creation payment system receives this money when a good is sold, and using the money supply provided by the central bank, splits the payment in two. This is called split velocity in the Greater Poverty and Wealth of Nations. 100% of the money received from the sale is used by the industry or business on all non-human capital expenses. These can include raw materials, transportation, fuel, electricity, and so on. 100% of the new financing that is now regarded as profit is paid to households. Please note that when we say households here, we're talking about the staff working in a business or industry and the shareholders. This is what we'd refer to as human capital. Wealth creation recovers the 40% loss that industries or businesses faced and restores it to its business activity. And it takes the 60% loss in revenues that was being lost by households, and these funds are recovered by households. Now, this recovery takes place at any point in time. So there's never a time at which the economy is experiencing scarcity or a loss. When banks and other financial institutions issue loans, people and businesses receive these loans when they begin to pay back the loans they have borrowed. What the infrastructure of the payment system does is that it takes this amount from one transaction and splits the velocity, moving this money in two directions. thereby increasing the efficiency of money supply. As mentioned earlier, this is referred to as split velocity. The bank receives 100% of the principal as profit to make credit creation more accessible to the public, and it also receives the principal paid back by borrowers and uses 100% of this to issue out new loans. This means that a bank can issue $20,000 as a loan and receive $20,000 paid back as the principal without charging interest, and use this to issue new loans and make a profit of $20,000. The entire amount of the repaid principal is now the bank's profit. Once again, scarcity beneath the circular flow of income is now dealt with by wealth creation. This is achieved without inflation, at constant price, for the following reasons. Industries have no incentive to raise prices anymore. Industries already enjoy a very hefty price markup even though they sell goods and services at cost price. They no longer need to charge more than cost price for products they sell. The fourth reason why inflation is unlikely to take place is because of an increase in supply chain efficiency. When a good is being consumed at F on the shelf, its reproduction is already being accelerated by split velocity along the supply chain at A, B, C, D, and E, putting goods back on the shelf almost as quickly as they are being consumed. Despite increases in money supply, these conditions may create a tendency for prices to tend to fall over time, and money to move toward deflation instead of inflation. Constant price means the increase in money supply takes place without inflation. A commission is charged for the distribution of wealth creation as a service. This service restores money being lost beneath the circular flow of income that is creating scarcity or poverty in any economy in which it is applied. In Zambia's case, $20 billion worth of kwacha in money supply provided by the central bank accelerates business activity by financing worth an additional $20 billion in 1 year at constant price. The Reserve Bank provides the money supply like it does for credit creation. This money supply is equivalent to GDP, as shown by the process in this diagram. Wealth creation channels these funds through industries at constant price, accelerating economic activity and therefore growth and development in an economy. Wealth creation as a financial service ensures the supply occurs at constant price. The cheapest method for stopping money losses beneath the circular flow of income that create poverty or scarcity is for the Reserve Bank to supply this money. This money is equal or equivalent to GDP. It may cost as little as 15% of GDP for the Reserve Bank to create this new money supply. Wealth creation as a new financial service virtually guarantees this increase takes place at constant price. For a small value of creating money, you are able to spend the equivalent of GDP. Government can now accelerate economic growth and development in the economy through businesses, thereby wiping out unemployment and other problems that were being created by scarcity beneath the circular flow of income.
There's nothing difficult about what I'm explaining. But of course, even simple theories sometimes require complex explanations in terms of the mathematics, the models, and so on. But if you understand the basics and you appreciate how those basics function within the economy, sometimes it's good enough even for a layperson to have an understanding of why economies behave the way they do, why wealth is distributed the way it is, and how an economy can be improved to give people a better life than what we see in the world today. And I think for governments around the world struggling to improve the conditions that their people face, I think the greater poverty and wealth of nations is an opportunity to transform people's lives. I think it's actually the first comprehensive opportunity we have to actually end poverty. I don't think we have had this opportunity before. We haven't had a science or an approach in business and economics that will actually end scarcity, because scarcity has been so intrinsic, it has been so ingrained, it's in every aspect of the economy that to be able to find a solution for it, you'd actually have to step outside what we understand and find a solution. As I explained earlier, even if you look at economics and its approach to how we manage resources, it tends to be a little bit defeatist, because human wants are infinite, resources are scarce. How do we make do in a situation in which there's scarcity? Whereas in the greater poverty and wealth of nations, the approach that I use is basically to say, how do we end scarcity itself? Because by ending scarcity, the flip side of that is we generate wealth. And if we generate sufficient wealth, then there's no one in any economy, no individual, no household that has to do without. The economy can actually take care of everyone. And the fact that you can raise financing equivalent to GDP is phenomenal, because it means that we have more than enough resources to take care of every man, woman, and child in an economy. We just have to improve its efficiency. We just have to apply money in a way that is going to break up the scarcity beneath the circular flow. And then from then onwards, I believe that we're actually looking at a point at which no one really has to suffer as a result of having to do without, or inadequacies, or scarcity. We can begin to move on. I mean, even, it doesn't matter whether we're talking about the grocery store at the corner, or if we're talking about Elon Musk launching rockets into space. The cost factor and the new resources that resource creation brings into an economy transforms every sector. Imagine being able to take your total revenue as your profits and no longer have to walk away with a slim profit margin, a tiny 10% or 15% or 25% or 2% profit margin. Instead, a business is able to walk away with close to 100 or 90 or 80% of its profits as total revenue. And those resources become available to households and the owners of the business. I mean, we're talking about businesses not only being able to do that, but to take the equivalent of total revenue and invest that in research and development, in buying raw materials, in employing more people. So we're basically talking about an economy that is able to transform lives, and that I believe most governments would want to introduce in order to improve the economic conditions that their people face. The fact that this financing is equivalent to GDP is actually very important, because what it means is that you have a financial tool that is equal to the task in terms of moving an economy forward. I've already given you some examples. If we introduce wealth creation in Zambia, for instance, Zambia's economy at the moment is around $20 billion US. If wealth creation is introduced countrywide, from the moment that it's introduced, at the beginning of the financial year, from the time that it's introduced, that year the Zambian economy will experience, at constant price, an injection of $20 billion. In other words, it's financing that is equivalent to current GDP. And so the impact of that kind of financing on the Zambian economy will simply be profound. I gave you an example of Kenya, which has a GDP of $60 billion. Now, if you introduced wealth creation, within 1 year, the Kenyan economy would see an injection of $60 billion at constant price to finance business activity. So what you'll see is businesses employing more people, businesses buying more raw materials, businesses marketing their products. In other words, it's an explosion of business activity in the economy that provides the solution to the end of poverty and the end of unemployment and a lot of the other problems that we face. I gave you an example of the South African economy, which is at around 290 billion. Since the South African economy is already at 290 billion, if you introduced wealth creation through the finance ministry and the central bank or the Reserve Bank, you would find that the South African economy would have $290 billion worth of financing for that year to enhance business activity. So what you're actually doing is you are facilitating or creating an environment in which businesses can thrive better than I believe they have ever done in history, in the entire history of economics and our understanding of businesses. I think once you introduce wealth creation, the level at which business or economic activity accelerates will be greater than at any time in history. Now, I've given you economies from developing countries, like African countries, but I mean, look at the United States. The United States has a GDP of close to $20 trillion. So if the US government, for example, through the Federal Reserve, introduced wealth creation as a financial service, then you're talking about an additional $20 trillion in 1 year at constant price being introduced into the US economy. I don't believe that even the US economy, as massive as it is, it being the most powerful, the largest and most successful economy in the world, I don't think the US has ever in its history experienced that kind of financing. And it would also be interesting to see what kind of impact resources equivalent to $20 trillion in 1 year being channeled through businesses and enhancing business activity in the US, what impact would that have on households in the US, on unemployment, on lifestyle in the US, on exploration, on research and development, on space exploration? I mean, what kind of impact would those kind of resources have? China has a GDP of 11 trillion. That means wealth creation for China can generate an additional 11 trillion worth of financing in 1 year. The good thing about wealth creation is it looks at the size of the economy where it is, and it provides a tool equal to the task that is able to move an economy proportionally to the size that it has arrived at or that it has grown to, by being able to create financial resources for that year equivalent to GDP. So wealth creation is a tool that is commensurate with our times and our needs in this day and age. The United Kingdom, for instance, has a GDP of 2.6 trillion US dollars. But if you introduce wealth creation to the United Kingdom, then Britain, within 1 year, would be looking at financing equivalent to 2.6 trillion United States dollars at constant price, injected into its businesses, accelerating business activity, and basically growing the economy in a way that hasn't been possible in the past. Another example, the EU also has a GDP of close to $20 trillion. And so you're talking about EU countries, if they introduced wealth creation through the ECB, the European Central Bank, and managed this through the financial system, through banks and other financial institutions, the EU would be able to raise financing equivalent to $20 trillion in 1 year to accelerate business activity. Now, in episode 4, this episode is about the business economy. And I think going forward, we need to start talking more about the business economy rather than just the economy. We need to look at how the business economy functions. One of the biggest hurdles that wealth creation is likely to face is the believability factor. I think it will be difficult for people initially to believe what a service of this kind can do because of the scale that it works on. I think people are generally used to GDP growth rates of 1%, 2%, 6%. If a country reaches a GDP growth rate of 16%, everybody is astounded and it's considered a great feat. But when resource creation or wealth creation is introduced to an economy, its ability to generate wealth completely changes wealth creation scenario. You're now talking about having financing equivalent to GDP for a given year. I think when it comes to the management of economies, most people have been exposed to very low GDP growth rates, and the fact that no one in economics thus far has recognized the resources being lost beneath the circular flow of income that are equivalent to GDP. You know, that make it a fact that in order to grow by 6%, even just 1%, you have to waste at least 100% of GDP. That no one has identified as yet. So in order to make someone understand how these processes work and what they can achieve is what's going to be a bit of a challenge. I mean, wealth creation is transformative to an economy, and the growth rates that it can create are also transformative. You're talking about growth rates that no economic tool available in the present day can achieve. You know, where it doesn't matter what type of economy we're talking about. It can be the US economy, it can be the UK's economy, it can be Zambia's economy. You're talking to financing equivalent to GDP. And wealth creation can raise those kind of resources at constant price. And for someone to believe that a government or an economy can raise finances equivalent to GDP in 1 year is going to be very difficult to accept. People will think maybe that it's impossible, or it's out there, or maybe it hasn't been thought out carefully. So the challenge really is to get people to be able to accept that this sort of financing is actually achievable. I've gone out of my way to provide an explanation of wealth creation that is very simple to understand, and I believe the way it's been presented, whether you are a professional in finance, in economics, in business, or you're a layperson who is a professional in another field, or simply someone who is interested in economics and business, I think if you go through this episode, that's episode 4, you should be able to have a decent understanding of what wealth creation is, how it works, how it's applied in the economy, and how this particular new architecture of the payment system within the circular flow of income works. So when we change that architecture, what happens now is that when it comes to businesses, there's an increase in efficiency. So businesses, the total revenue that they earn is equal to profit, and it is also equal to cost, or what they can invest in a business. In other words, take for instance, if you're a school and your school earns $50,000 a year, it means that you'll be able to spend $50,000 a year on your school buying textbooks, building, creating new infrastructure, on labs, on your library. But at the same time, you'd be able to spend $50,000 on your staff and on your shareholders. Now, that is far more advantageous than the current economy that we have right now, which in a sense drives businesses down. So imagine the impact that would have on education. You'd find that we'd be able to have teachers who are better paid, we'd have schools which have improved facilities, and the general standards of education in the country would improve. And this is not just in the private sector. It will happen in government schools as well, because the revenues being collected by government from the economy in terms of taxes and so on would increase dramatically, because you're now talking about accelerated activity where businesses are concerned. So there's a lot more revenue for governments to gain. But let's look broader and further than that. We live in a world today in which we don't have resources to spend on, take for example, animal conservation. We have elephant populations of rhino. We have different varieties of animals that are at the point of extinction, but the economy today does not provide the resources to be able to save these species that are close to extinction. We have seas that are polluted with plastics and other pollutants. We don't have the resources with which to clean up these seas. Well, when we talk about wealth creation as a financial service, changing the architecture of the financial payment system, or the circular flow of income, we're talking about being able to generate enough wealth to be able to take care of not just humanity's needs, but also its wants. We'll be talking about being able to take care of the environment. Companies that today are major polluters will have the resources to invest in the technology, in the equipment that enables them to produce their goods in a manner that is pollution-free. So we'll be able to look at a cleaner environment. So wealth creation, in a sense, is a game changer, because it allows humanity to begin to improve its conditions, not just economically, but socially, and in terms of our corporate social responsibility. Companies are able to do a lot more than they are in the current economy. So think of it this way. The current economy loses money below the circular flow, which tries to push companies below the break-even point. Now, that's trying to shut business activity down. Whereas if you introduce wealth creation, the opposite happens. It pushes companies forward, increasing business activity. It finances both consumption and production simultaneously, and that way you accelerate growth, accelerate development, you wipe out unemployment. An economy such as this simply does not have room for poverty. There are sufficient resources to take care of every woman, man, and child. So in this economy driven by wealth creation, poverty will simply cease to exist. My appeal, of course, is to governments in developing countries. Developed countries can withstand these loss of circular flow of income because they have such large economies that are wealthy. So even when they have small, mediocre increases in GDP per annum, such as 3%, 4%, or 16%, those mediocre increases in GDP per annum are able to sustain their economies. Whereas in developing countries, we have smaller economies whereby even small increases such as that in GDP will have a very minimal effect on improving the welfare of our citizens. The other problem I feel is that with developing countries, we should not have to wait 100 years, 200 years, 300 years to be able to reach the level of growth in infrastructure, in health facilities, in education that developed countries enjoy. I believe we can, through wealth creation, what developed countries have taken 300 years to achieve, we can achieve maybe in 100 years or in 50 years. So we'll be able to shrink the time that it takes for us to move from a developing country to a developed country and provide our people with a much more improved living standard in a much shorter space of time. I hope you now have an understanding of wealth creation. Another side of wealth creation doesn't just provide efficiency in businesses, it also provides or brings efficiency to the credit creation process, which is of course managed by banks. If you introduce wealth creation to credit creation, which is being provided by banks, then banks are now able to issue loans without charging interest, and yet the income that they receive from issuing those loans is greater than when they were charging interest. If a bank issues a loan of $20,000, as I said earlier, it will receive $20,000 paid back as the principal. Then it will use this amount paid back as a principal to issue new loans, but it will have an additional $20,000 to invest in the growth of credit creation, to pay shareholders and to pay staff and to provide the inputs that will improve credit creation as a service. I think that improvement in efficiency is a much more desirable environment for credit creation, and I'm sure the banking and financial services industry would prefer to work in an environment in which they are able to issue loans greater amounts than they did without charging interest. And as you know, in some communities, interest is considered a taboo. So the ability of banks to issue loans without interest in a wealth creation environment actually improves the prospects and makes it possible to extend credit creation to a much wider. Therefore, wealth creation, I think, is a financial product or service that the banking and financial services industry should take an interest in. It provides governments the opportunity to transform the welfare and plight of their citizens. I mean, with wealth creation functioning in an economy, I gave the example of Zambia, where we would be able to raise an additional $20 billion in GDP to finance growth in the economy, and this would accelerate business activity, and I believe within 1 year would probably wipe out unemployment in Zambia from the time that the service is commissioned and begins to operate within the Zambian economy. So I believe this kind of financial service is one that governments should take an interest in.